Hey everyone, it is Hugo here, and I want to talk about something really important today, something that hits close to home for me. We are all hearing about the new leader at the Federal Reserve, especially with this massive $39 trillion debt crisis looming over us. Everyone is asking, will the new Fed cut interest rates like some want, or will they keep them high? Honestly, I have spent too much time in my life trying to guess what is coming next, and it has almost always ended badly for me. So instead of crystal ball gazing, I want to look back at history. It is funny how history does not exactly repeat itself, but it sure does rhyme. And let me tell you, I have seen these rhymes play out in my own life, often to my detriment. I remember back when I was in my early 20s, fresh out of college, with a decent amount of savings from working odd jobs and internships. I was bright-eyed and bushy-tailed, ready to conquer the world, or at least my financial future. I had this naive belief that I could get rich quick, that there was some secret formula to financial success that I just needed to uncover. I devoured every finance book, every article, every YouTube video I could find, especially the ones promising huge returns. The allure of high returns was like a siren song, and I, like many others, sailed straight into the rocks. I never grew up with much, so the idea of fast money was incredibly appealing. I saw friends, or rather acquaintances, on social media flaunting their supposed gains from some hot new stock or crypto. I felt like I was missing out, that everyone else was getting rich while I was stuck on the sidelines. This fear of missing out, this FOMO, it is a powerful drug. And it pushed me into making some really dumb decisions. I started chasing every hot tip, every rumor. Someone would mention a stock, and without doing any real research, I would jump in, sometimes with a significant chunk of my savings. I was not investing, I was gambling, pure and simple. I bought into short-term trends, thinking I could ride the wave up and then sell before it crashed. Newsflash, I rarely sold before the crash. More often than not, I was the one left holding the bag, watching my money disappear faster than it appeared. It was a painful cycle. I would see a stock go up, jump in, watch it climb a little more, then see it plummet, and I would panic sell, locking in my losses. Then I would see another hot stock, and the cycle would repeat. It was exhausting financially and emotionally. One of the biggest mistakes I made was falling for a sophisticated scam. It promised incredibly high, guaranteed returns, something like 1% daily. It sounded too good to be true. And guess what? It was. I ignored all the red flags, blinded by the potential for quick wealth. I poured a significant portion of my savings into it, convinced I had found the holy grail of investing. The first few weeks, I actually saw returns, which only fueled my delusion. I told my friends. I bragged a little, thinking I was a genius. Then one day the website was gone. Poof, my money gone. All those late nights, all that hard work saving just vanished. It was a gut punch, a brutal wake-up call. I felt like such an idiot, so foolish, so naive. Another time, I got caught up in a single stock, a small cap company that had some promising news. I did not diversify. I went all in, thinking I had discovered the next big thing. I had no risk management, no stop loss orders, just pure conviction based on hype. The stock soared for a bit. I was ecstatic, already mentally spending my future riches. Then the news came out that the company was not as solid as it seemed, and the stock crashed. I lost a huge chunk of my money, essentially wiping out years of savings from that one bad bet. It was devastating. These experiences, they stripped me bare. They showed me how dangerous it was to chase quick money, to ignore fundamentals, to trade on emotion. I realized I was not just losing money, I was losing confidence, I was losing sleep, and I was losing trust in myself. It took hitting rock bottom, financially speaking, for me to finally get it. I had to unlearn everything I thought I knew about investing. I had to let go of the fantasy of overnight riches and embrace the slow, steady path after that. I made a conscious decision to change. I started from scratch, learning about real investing, about value, about long-term strategies, about diversification. I learned about risk management, about not putting all my eggs in one basket, about understanding what I was investing in. I focused on building a solid foundation, on saving consistently, on investing in broad market index funds, and on understanding economic cycles, not just reacting to them. I developed a new mindset, one that values prudence over speculation, patience over impulsivity. The journey has been long, and sometimes still frustrating, but it has been worth it. I am no longer chasing rainbows. I am building a financial future brick by brick, with a solid understanding of the risks and rewards. That is why I am here, sharing my stories, my screw-ups, my lessons. I do not want anyone else to go through what I went through, especially not when they are just starting out. My goal is to help you avoid the pitfalls, to understand the basics, and to build your wealth intelligently and responsibly. So, let us dive into some of these historical patterns and what they might mean for us today, especially with the Federal Reserve and the economy in such a dynamic state. I am going to talk about some general investment ideas that have historically done well, regardless of what the Federal Reserve is doing, and some that are more sensitive to interest rate changes. This is not financial advice. I am just a guy who has been through the ringer, sharing what I have learned. Always do your own research. We have seen three major Federal Reserve cycles in the last 50 years, each with its own lessons. The late 1970s, after the stagflation crisis, 2008 with the financial crisis, and 2020 during the pandemic. Now the big question is, will 2026 be another one of those cycles, especially with our national debt climbing to over $39 trillion? It is a huge number, and it means we need to be prepared to be smart, not just react. In the late 1970s, to fight stagflation and high inflation, the Federal Reserve hiked interest rates aggressively, all the way up to around 20%. Inflation was a huge problem, and they had to act decisively. Over the next 5 years, cumulative inflation was around 52% wages, however, only grew by about 36%. This means that the average person working a job became poorer in real terms because their salary simply could not keep up with rising prices. Your money just bought less stuff. Now let us look at asset prices during that same period. The stock market surprisingly grew by about 54%, just barely beating inflation. Real estate prices did not keep up, and gold prices actually stayed flat. After a very volatile period where they first skyrocketed, then came back down, Bitcoin did not exist then. Obviously, who got wealthy during this period? It was not the average worker. It was mostly people holding cash and bonds, those earning 15% interest on their money, beating inflation because interest rates kept going up. They were the ones who saw their wealth grow. Fast forward to 2008, the housing market collapsed, the economy was in freefall, the Federal Reserve stepped in, cutting interest rates and printing money to stimulate the economy over the next 5 years. Government numbers showed cumulative inflation at approximately 11%. Median income grew by a little under 7%. Again, the average person relying on their salary became poorer because their wages did not keep pace with price growth. But what about assets? The S&P 500 grew by around 200%. Real estate prices grew by about 50%. Gold prices grew by around 70%. Again, Bitcoin was not a thing who became wealthier this time. Not those holding cash or bonds. It was asset owners, people who owned stocks, real estate, and gold. They saw their wealth increase significantly, while those just working for a paycheck slowly got poorer. The pattern here is becoming clearer, is it not? Then came 2020. The pandemic hit and the economy shut down. The Federal Reserve again cut interest rates to historically low levels and started printing money like crazy. We all remember that. Right? Inflation surged again. Cumulative inflation was about 25% between 2020 and 2025, according to government numbers. And I say according to government numbers because many of us felt the inflation was much higher in our daily lives. But let us stick with the official figures for consistency. Median income also rose, but only by around 20%. So, yet again, wages did not keep up with rising prices. The average person relying on their salary became poorer because their money bought them less. Now, for asset prices after 2020, the stock market, specifically the S&P 500, boomed by about 160%. Real estate prices boomed by around 45%. Gold prices boomed by around 125%, and Bitcoin, oh boy. Bitcoin shot up by 1,600%. That is 1,600%. This was a wild ride, and I saw so many people, myself included in some ways, getting caught up in the hype again. When interest rates are cut and more money is printed, it fuels speculative investments. Why? Because borrowing money becomes cheap. Investors, institutions, banks, everyone can borrow at 1, 2, 3, or 4% and only need a 5, 6, 7, or 8% return to justify the investment. So there is a flood of cheap money, and people are looking for places to put it. This is when speculative assets really take off. Venture capital firms pumped money into all sorts of risky ventures. Valuations skyrocketed. This environment certainly helped fuel the rise of Bitcoin. When people are worried about inflation and the value of traditional currencies, they often look for alternatives. And Bitcoin was seen by many as a hedge against hyperinflation. It went from around $7,000 a coin in early 2020 to well over $100,000 at its peak. So in these periods of interest rate cuts, asset owners, especially those in speculative assets, saw incredible gains. It was not just Bitcoin, but many other speculative investments across different markets. As interest rates went down, valuations in these risky assets went way up. Now here we are in 2026. We have a new leader at the Federal Reserve, Kevin Warsh, who started on May 15th. He was appointed by President Trump, who publicly wants lower interest rates. Trump has made it clear he would not appoint anyone who does not support lower rates. So on one hand, many people and a lot of the media are predicting lower rates because of Trump's influence. But Warsh himself has said he is not sure about cutting rates because inflation is still a problem. This is where it gets complicated. You usually lower interest rates when inflation is not an issue because lower rates tend to make inflation worse. In the late 1970s, they raised rates to fight inflation. So lower rates boost the economy but worsen inflation, and higher rates fight inflation but can slow the economy. Today, in 2026, we are facing both problems. We have economic slowdowns, that massive $39 trillion national debt, and also rising inflation, fueled by things like higher oil prices, geopolitical conflicts, and government spending. It is a tough spot, one we have not really seen in about 100 years. Our national debt is around $39 trillion, while our economy is about $31.9 trillion, giving us a debt to GDP ratio of about 122%. To put that into perspective, most banks want a 20% down payment on a house because they do not want to lend 100%. We are essentially 122% underwater as a nation. The last time our debt to GDP was this high was after World War II in the mid-1940s. This is the aftermath of the pandemic, and it is a serious challenge. What the Federal Reserve does next will make some people incredibly wealthy. We just do not know what that decision will be yet. But we do know that specific decisions favor specific types of assets and people. When the Fed raises interest rates, it is generally good for people holding cash and bonds. Your savings accounts pay more, government bonds pay more when they lower rates. Speculative assets generally do well. Now, this does not mean traditional assets like stocks and real estate do not benefit when rates go up. In the long run, both stocks and real estate tend to do well, regardless of rate movements. But when rates are rising, people often prefer safer investments, and speculative investments struggle because it is harder to borrow money for them. When rates are cut, more money circulates, more investments are made, and speculative assets can boom. Everyone has an opinion on what is coming next, but we will not know for sure until the Federal Reserve's next meeting on the 16th of June and 17th. That is when Kevin Warsh will likely give his first official statement as chairman. This is why I am hosting my live investor workshop on the 16th of June. If you have not registered, the link is in the description. Again, I am not a financial advisor, so please do your own due diligence. Investing always carries risks, and you will likely lose money at some point. It is important to remember that the Federal Reserve's decisions are not made by one person. There are 12 voting members, and a majority vote is needed. Kevin Warsh is just one vote. The current Federal Reserve is one of the most divisive we have seen, with many dissenting opinions. Some want to keep rates steady, some want to cut, others want to raise. This internal division makes Warsh's role even more crucial, as he might sway the bank one way or the other, and whichever way it goes, some people will become wealthier. That is the crucial part to understand. So let us talk about some general investment ideas, not as advice, but as ways to think about how different scenarios might play out. Example number 1, investing in the broad economy. Historically, investing in the stock market for the long term, especially broad indexes, has been a winning strategy whether rates are going up or down. One way to do this is investing in the S&P 500, which is the 500 largest U.S. companies. Funds like VO give you exposure to this. Full disclosure, I personally own VOO. Another option is VTI, an ETF that gives you exposure to the total U.S. stock market, covering around 2,000 companies. If the stock market goes up, your fund goes up. If it goes down, your fund goes down for something a bit more niche. But still broad, you could look at the NASDAQ 100, which includes the 100 largest non-financial companies, mostly tech firms and AI companies today. The NASDAQ 100 tends to be more speculative, so it can go up higher when markets are strong, but it also falls harder during market downturns. It has often outperformed the S&P 500 over decades, but comes with more volatility. Example number 2, real estate. This asset class also tends to do well in the long term. Regardless of Federal Reserve actions, I usually prefer talking about physical real estate like rental properties, whether residential or commercial. But buying physical real estate is expensive, time-consuming, and not for everyone. An alternative is investing in real estate through the stock market using REITs or real estate investment trusts. REITs are companies that own or finance income, producing real estate. They have a rule that they must distribute at least 90% of their taxable income to shareholders as dividends, which means they often pay strong dividends. An ETF like VNQ gives you broad exposure to the U.S. real estate market through REITs.